Good evening, shareholders of HRNet and participants. On behalf of HR Group, we would like to thank everyone for joining the HRNet Group Investor Day. I'm sure tonight you will find out more about HRNet Group and determine if it's a good fit for your investment portfolio. HRNet Group was listed on the main board of the Singapore Exchange in 2017 and is one of the Asia's leading recruitment and staffing firms. They are established across 15 cities in Asia, and the businesses collectively provide the best services and solutions for companies, leaders, hiring managers, and job seekers. We will kick off with tonight's session with a short video on HRNet Group, followed by opening remarks by Ms. Adeline Sim, Executive Director and Chief Corporate Officer. She will then give a short corporate presentation together with Ms. Jennifer Kang, Group CFO. Joining us tonight as well will be two independent research companies to share their views on the company. Please note that any information shared is not meant to be a recommendation for investment by SIAS. Without further ado, let's watch the video. Thank you. May I now invite Ms. Adeline Sim for her opening remark, please. Over to you, Adeline.
Thank you, Eileen. Good evening, everyone. Very happy that you're able to join us to basically learn more about HRNet Group. I would actually like to thank Benjamin from SIAS for this really interesting format that he instigated. So I think for the first time tonight, what you're seeing is that, not just Jennifer and myself from the management team will be sharing about the company. We also have with us our independent director, Albert Ellis, calling in from London. And Albert is a very experienced person in the HR industry. He knows the space in and out. And we have known him since he was CEO of a company called Harvey Nash that was listed in London with operations in Vietnam and the UK. And today, Albert's actually the CEO of Staffline. Then, apart from Albert, who represents basically all our shareholders, we also have Paul from Phillip Capital and Rhiannon, who's calling in from Storm Corporate Research. So what you find is that tonight we have a concept where you have both the insiders as well as the external view of the company from people who really know the industry and the space. So I do hope you really enjoy yourselves and ask away, as in ask any questions you might have. So going a little bit back into the company, just in case any of you are not already shareholders, we are very much a homegrown pan-Asian platform, right? In 15 cities, as Eileen mentioned, we are plugged into growth sectors in cities across Asia, and we make real money, right? So the valuation of this company, it's based on actual net profits, and just this year alone, we have paid 6.1 cents in dividends per share. And I think there's really a lot to tell you about. So I'm just going to hand it over to Albert to share what he thinks about the company, coming in as an independent director. And then later on, Jennifer and myself will give you a bit more details as well. Yeah, so hello, Albert.
Hello, thank you, Adeline. I hope you can all hear me.
Yes, all good.
The miracle of transatlantic undersea cables internet. So I'm speaking from London here. And yes, I just want to echo Adeline's wonderful and very complimentary introduction there. I've got 30 years of experience in the sector. well, it'll be just on 30 years, beginning of next year. So there's some good karma with HRnetGroup's 30 years of being in existence. As Aline said, our relationship formed some time ago before Staffline, when the relationship was born out of an investment, and that relationship has grown over the years. As someone who knows the sector, I recognise that HRNet really does demonstrate tremendous characteristics of what I consider the best in the best of recruitment. Those are things like alignment with owners, innovation in your incentives, motivation. These act as a retention tool, and in recruitment, nothing is more important than retention. The success and the motivation model also exerts a downward force on costs. As you all know, cost control is one of the great challenges in an inflation environment, and this model is uniquely suited to actually helping drive those costs down. And of course, I think most importantly, my lessons from HRnetGroup, and this is really directly from the founder and the board, is that actually I've learned so much about profit after tax and cash and dividends, and those are the really important elements of an owner-led business. So in conclusion, I must say, Adeline, your balance sheet in a macroeconomic uncertainty, we've just had our third prime minister in 3 months. So there's uncertainties, there's storms, economic storms. And in times like this, your balance sheet is your armor. Cash is king. In the Western hemisphere of the world here, they forget that all the time. Glad to see that HRNet prizes cash above all else. Organic growth, the most accretive value that you can add in recruitment, organic growth. Of course, acquisitions have their place, but a main strategy of organic growth is the most accretive and valuable shareholder enhancement. I've said alignment with owners is just so critical. And then finally, the fact that you have a team and you have one culture, I can't emphasize that enough, teamwork and culture, that not one individual is elevated above the rest. Everybody works for the good of the company. So with that, Adeline, hopefully some brief opening remarks for you to continue.
Thank you very much, Albert, for a very kind introduction. And I think talking about the cash we hold, let's introduce the lady who basically manages over 300 million in cash. Jennifer, please.
Thank you. Thank you, Albert. Thank you, Adeline. I'm just waiting for the slides to come up. Yes. Bas? Can we have the first slide, please? Yes. Many investors consider HRnetGroup as a proxy for the Asian Economic Barometer. So it is of no surprise that we received a lot of questions. In fact, majority of the questions from our participants today were asking about the business and the impact of inflation and recession. Under such volatile market conditions, HRnetGroup is indeed a shelter for safety, as it is a business that is highly profitable and cash generative. We have 37 co-owners running alongside 1,200 people across 32 BUs, 40 offices in 15 Asian growth cities. And most importantly, this is a stock that pays good dividends 2 times a year. I'll take some time to talk about the cash position for us, which is a shield in the face of rising interest rates and a sword in the face of expansion and acquisition opportunities. As of first half 2022, we had a net cash of 313 million Singapore dollars. HRnetGroup's cash position is a function of our low capex intensity model and strong free cash flow, which represents a significant advantage over other companies. Our strong balance sheet provides sufficient working capital to be able to hire significant numbers of people at short notice. From first half 2020 to first half 2022, we increased our contractor numbers from 12,000 to 17,000 within our working capital, allowing us to move very quickly and take advantage of strong demand at short notice. In the event of a rapid and ongoing increase in regional interest rates, our net cash position further differentiates us from our peers, as a number of companies are struggling with interest-bearing debt commitments, with potential for some smaller operators to go bankrupt and offer themselves up for sale. A strong balance sheet for us simply means we can pay progressive dividends and take advantage of share buyback opportunities. The $30 million ongoing share buyback program and our first ever interim dividend bear testament to our commitment to shareholder returns. As of today, we have already paid 6.13 cents per share, or $61.3 million in dividends this year. Shareholders who have held the share since beginning of the year would have received 7.6% yield. Last year, we did $65.9 million of underlying profits out of a revenue of $590.5 million. Few of our peers can compare with a conversion rate of 29.3% from revenue to GP and 46.6% from GP to underlying profit. This year, first half, we already achieved 65% of last year's full year underlying profit and 53% of last year full year's revenue and GP. A key strength of HRnetGroup is our diversity. This is a threefold diversity, with diversity of businesses in flexible staffing and professional recruitment, diversity in geographic location, and diversity of exposure to different industries. This diversity allows us to focus on faster growing areas of different regions' economies. I'll first talk about the first diversity. First, if you could go back to the first slide, I'll just focus on the business aspect of our diversity. So since many participants asked about our business model, I shall expand on this part. First, can we just limit to the business portion? Yes. So we have two lines of business: professional recruitment and flexible staffing business. The two businesses are complementary, providing margin stability across differing economic and recruitment cycles. The flexible staffing business tends to be a steady revenue stream through an economic downturn, while the professional recruitment business is typically more geared towards economic growth. The mix of temp and permanent recruitment solutions means HRnetGroup is able to provide comprehensive recruitment and staffing solutions from junior through to more senior positions. For professional recruitment, HRnetGroup sources and selects talents to be employed by our clients. Professional recruitment services are primarily conducted under the HRNet1, PeopleSearch, Search Asia, and Reforce brands. The focus is on permanent recruitment for mid to senior level placements, a business that can be geared into an economic cycle, and the business has the gross profit margin of 99%. As of first half 2022, professional recruitment business accounts for 57% of the total GP. In terms of the fees, HRnetGroup constantly maps talent markets and analyzes intelligence regionally to be able to advise our clients on who they should hire, for what role, and how much. Fees are expressed as a percentage of salaries offered to talents. The mid-level professional recruitment fee ranges from 18 to 25% versus the senior level professional recruitment fee rate of between 25 to 35%. In 2021, we placed 7,794 people in mid to senior positions. We have maintained our fee level for the last several years, but given the inflationary market conditions, we are aiming to set new pricing standards that are more aligned with the value and cost of delivery. Higher fees with clients would be positive for revenue growth. As for the gross profit, Professional recruitment GP is driven by the increase in salary levels, which has been rising rapidly across markets in many key sectors due to tight market conditions. The Great Resignation wave in Asia started in 2021, triggered by the change in mentality towards better work-life balance during COVID lockdowns and continued through first half 2022. As people moved jobs, demanding a 20% salary increase was considered normal, but it rapidly became a 30 to 50% increase due to the tight market. The resignation wave has since slowed, with some becoming boomerang workers, meaning people who regret quitting and wish to be re-employed by their former employer. Instead, the resignation wave is now being replaced by the inflation wave, giving workers justification to demand higher wages. That's for the dynamics of professional recruitment. Now I'll tell you more about flexible staffing. Flexible staffing operates mainly under the Recruit Express and Recruit First brands, and is the core monthly recurring business supplying manpower on demand. The majority of the hires are focused on junior to mid-level positions in Singapore, with rapid expansion happening in Taiwan and Indonesia. Contracts can be for short-term, project-based work, or temporary replacement to permanent hires. We continually refine our processes to deliver an on-demand workforce with the greatest efficiency. The first half gross profit margin was about 15%, and flexible staffing accounts for about 42% of our gross profit. Flexible staffing is a popular method of hiring given the uncertain macroeconomic environment due to the flexibility, the reduction in hiring risk, and the lower overheads that flexible staffing offers. Businesses can access talents when required without having to take on the cost of hiring and training permanent employees. It is also increasingly in demand among contractors. Flexible working has become more respected and mainstream due to the COVID-related acceleration in lifestyle expectations. Flexible working through an agent is also regarded as a route into a specific company that may not have been accessible as a full-time employee. HRnetGroup hire contractors have flexibility, but also have employment benefits such as paid leave and insurance. Flexible staffing demand tends to be strong when the professional recruitment demand is weaker, and that acts as a natural hedge. In recent years, it has been strong regardless of economic conditions, driven by the expansion of new flexible staffing offices, generating organic growth, as well as a greater available talent pool due to the change in perception of being a contractor. Unlike some of our peers, HRnetGroup employs contractors on a back-to-back basis, thereby limiting liability and exposure. There is no cost of talent inventory holding. Barriers to entry are high in that working capital is needed for financing contractor payroll of at least 2 months, as clients may take time to pay the invoices. The number of our contractors engaged in 2021 had increased to a historical high of 19,280. HRnetGroup engaged with 54,000 people over the course of 2021. Once companies start using HRnetGroup, they tend to continue because as clients become familiar with HRnetGroup's integrated systems, digital timesheets, and organizational methods, they stick. The next diversity is geography. We have been growing our regional footprint at the rate of a new city every other year. We are focused in Asia, with Singapore as our headquarters contributing the largest share of 56% in gross profits, and 40% comes from North Asia, comprising 6 major cities in mainland China, that is Shanghai, Beijing, Guangzhou, Suzhou, Shenzhen, Chengdu, Taipei, Kaohsiung, Hong Kong, Seoul, and Tokyo. And the remaining 4% comes from the rest of Asia, being Jakarta, Kuala Lumpur, and Bangkok. The Asian labor markets that we operate in remains very tight. Competition for talented human resources is intensifying globally post-COVID, with many Asian cities now rolling out programs to attract foreign professionals, particularly in innovative sectors such as digital technology and biotechnology. According to a survey, 75% of approximately 40,000 companies globally reported challenges in hiring employees they need in 2022, compared to 54% in 2019. Notably, 88% of Taiwanese companies surveyed and 84% of Singaporean companies surveyed reported challenges in hiring talent. Singapore, Thailand, Malaysia, Taiwan are all implementing initiatives to bring in more human resources, and Japan is trying to catch up with Asian nations by planning to expand programs for high-skilled foreign workers. There were some questions about China. Mainland China today is an ecosystem of its own. Under the dual circulation policy announced before COVID, that it will continue to strengthen its domestic economy through government subsidies for tech industries such as semicon that we specialize in. Chinese investors, family offices, and companies have also been setting up regional HQs or alternate HQs in Singapore. Taiwanese companies have been flowing to Southeast Asia since 2016, when their government announced the NSP, New Southbound Policy. In 2010, Taiwan used to have some 80% of outward direct investment to China. In 2021, that has fallen to around 30%, while a similar portion has shifted to Southeast Asia. ASEAN, as highlighted by HSBC Global Research, is very resilient. My apologies, let me repeat that. ASEAN, as highlighted by HSBC Global Research, is very resilient. It is in a better shape than GFC. We now have below average inflation. Our share of global FDI has risen sharply since the GFC. Our banking systems generally have capital adequacy ratios that have since improved strongly from GFC time. We have all just walked out of the pandemic, and growth is expected to be spurred by consumer demand and tourism revival, and the digital economy is charging ahead. Finally, the third diversification is the client and sector. As of first half 2022, HRnetGroup's top 5 clients accounted for 14.3% of total revenue, having been clients of HRnetGroup for an average of 19 years. The top 10 clients account for 22% of revenue, and the client base is diversified across a number of different sectors, reducing the impact of adverse conditions impacting any single sector. We do not expect any major change in industry exposure over the medium term, and expect significant contribution to continue to come from IT technology, healthcare life science, and financial services. The apparent erosion of Hong Kong's financial status is likely to be an ongoing positive for core Singapore market. Some color on the various sectors that we focus on. Healthcare life science, as of first half 2022, this is a sector that has been the largest revenue contributor at 22%, although it has declined by 4 percentage points after a strong 2021 due to COVID vaccination work. Vaccination-related work declined significantly in the first half, but has been partially offset by non-vaccination hospital work, as our hospitals are attempting to catch up with chronic cases delayed during COVID. On technology, first half technology earnings remained strong. Fintech growth was driven by app-oriented online shopping, food delivery, and ride-hailing. HRnetGroup supports the smartphone and technology supply chain from semiconductor design to manufacturing of end products, with growth expected to remain robust as the market expands. And for the finance sector, first half finance-related earnings were very strong. Growth since 2021 has risen from areas such as wealth management, the consequence of the exodus of bankers from Hong Kong to Singapore, and the shifting of Chinese money as wealthy mainland Chinese settle in Singapore. Buy now, pay later demand has also been picking up, accounting for some growth. And for manufacturing, it's clean industry or white-collar, higher value-added manufacturing that is picking up in Singapore, with demand from multinational companies, including some semiconductor manufacturing, as heavier manufacturing has shifted to China and Vietnam over the years. There was a question on our expansion approach, and I take this opportunity to share with you the 3 approaches that we have. And the first one is organic. We start up companies when our clients have the demand and when we have capable people who are ready to invest personally to build the business and cultivate people for the long term. Our flexible staffing business outside Singapore will continue to expand organically, and there is a lot of upside. There will be a new startup that we're going to announce to do beyond the current professional recruitment in North Asia. The second approach is our inorganic approach. We work very well with like-minded entrepreneurs who want to continue to own a substantial stake and see potential in the future to sell a certain percentage of the company's shares based on an earn-out structure. There must be synergies. There must be profit accretion. So far, we have done 3 acquisitions and integrated them beautifully. The most recent acquisition of Optimate is a game changer, and we will be spearheading the business into Japan and Indonesia. Adeline will share more about that later. And finally, the combo effect. This term was actually coined by Paul, who is in a panelist today. This is where the co-owners of acquired businesses, they had good integration experience with us, and they want to do even more by investing in new ventures together. China will see us investing even more in flexible staffing through this combo channel to capture the market potential. And finally, HRnetGroup is a business that has not only survived 6 crises, but also emerged much stronger after each one. As a co-owner-run company, there is no doubt that we are fast and nimble to be able to pivot to pockets of growth in the sectors, navigate through the flow between the cities and business segments. Unlike most companies, we have the luxury of cherry-picking growth. Let me now pass the time to Adeline to share about how we organize our people and deploy technology to be ahead of the market and our peers. Thank you.
Thanks, Jennifer. So I think on the next slide, what you're going to see is the current composition of our board. And everything has to start from the top, right? And in the current hyper-localization of the labor markets, it became very apparent to us that we needed very strong local experts on our board. So in the past 10 months, we've actually had Wallace Gao, who is the co-founder of Korea International, which is listed in China, and he actually joined us as an independent director. And then we have Hank Sato, who is now CFO of B Next Umation, listed on the Tokyo Stock Exchange. And previously, Hank was the CFO of Technopro, who some of you will remember, Technopro was a cornerstone investor at our IPO as well. And Hank has joined our board to give us, that very strong local knowledge of the Japanese market, right? And of course, you've all met Albert, and Albert really knows this industry really, really well. And yes, and is a great addition to the team as well. So what you see here today is that from the board level, we have already, changed its complexion totally to take into account what has happened over the past 2.5 years, right? And it's a reflection of how quickly we react as a company. And I would say that, we are really very happy with both the local expertise in the form of May and Chenny, who are both very familiar with the local markets, and then Wallace, Hank, and Albert, coming together, joining hands, and making sure that as a board, we're really, really strong as well. So that's our newly composed board. And then to bring it to the operating level, then would be our co-owners, right? And at the point of the listing, we had 22 co-owners who are actually business leaders on an operating level. So they hold shares in the operating entities that they respectively run. Today, 5 years later, we have added so many more, right? Both through organic growth as well as inorganic growth. And we now have 37 co-owners, business leader co-owners. You'll see their faces on the next slide. And all these people basically are running and have P&L responsibility for the unit which they own. We find that this operating model works really, really well. You don't have anyone who basically thinks that, I'm here to spend the budget. Nobody thinks like that. I think Albert's very sensitive to it as well, because he found that, how is it that we're so profit focused? But it goes back to the ethos of the company. And every one of these people basically, started up something and grew with it, and it's their baby, right? And the majority of their income is meant to come from dividends. So they're very conscious about it. I think we are very forthright that we pay competitive base salary, but never high. Because the whole idea is that we want people to make most of their money from dividends and from profit sharing. So there was a question earlier about, how the current situation might help us, might affect us, given how salaries are all heading north. And when you come right down to it, I think, we are always very conscious that we only want to pay people who are profit generating. And this whole co-ownership model really works very well that way. So you have the business leader co-owners and a very strong bench, much stronger today than at the point of the listing. Then recently as well, I think there were 2 recent awards that HRnetGroup was recognized for. Deloitte actually has awarded us one of the best managed companies in Singapore, and that was really nice recognition from Deloitte. And then Dun & Bradstreet as well recognized the group as a whole. So you do see representatives. I think in the Dun & Bradstreet case, what you see here are the 10 people who had the highest sales in the first half year in Singapore. So it was really nice to recognize them. So you can see that we have worked very much on our people. And the other thing that we have worked very strongly on is our technology, right? So just like many companies, so earlier on, Jennifer mentioned that, we still have a good chunk, 20% of our business or so coming out of technology. And there was some concern from the FAQs we received earlier about whether or not, the current situation for the unicorns would affect us. And the answer is no, because we are very clear where we have to pivot to. And that is actually to the tech teams in the more traditional companies, in the JP Morgans, in the government departments of the world, who in the past 2 years were priced out of the market. They just couldn't hire engineers when you had, Shopee and Lazada throwing out $10,000 packages for fresh grads, right? It priced the software engineers out of the market. And today, you do find that the local conglomerates and the stronger companies are coming back to say, we need to hire for our tech teams and we want to grow there. So our tech specialization is actually changing. You can see the complexion of the client profile changing but you can be sure that they're as busy as before, if not more busy. So internally as well, we have been really building up our digital suite. And today in Singapore, you'll find that anyone who applies for a job with us can basically, with one click, allow us to suck in their info from MyInfo, from the government platform, and that will fill out the whole form for them already. And then with their letters of appointment as well, we draw in the data from MyInfo, which means it's all clean data. And then they can just sign off the letter of appointment on their phones, right, with digital signatures. When it comes to timesheets, it's all selfie, check-in, check-out with GPS fencing for clients who wish to do so. And the whole experience actually is now can be found on your phone. The whole employment management, the whole contracting management system. So that's something that we're very conscious about. We believe that, many of our clients actually need this service today. They can be sitting in the US, they can be sitting in way different cities, and they want to know that their contractors have turned up for work, and they want to be able to approve, overtime requests. And our whole digital backbone now allows them to work seamlessly, 24/7, and in a very transparent way. And that actually brings us to the acquisition of Octomate. So Octomate, we're really, really happy to welcome Zoe back to the family because she first joined us as an intern, I think 8 years ago, if I'm not wrong, before she went off to start a startup. And Octomate now allows us to basically make instant payments to contractors. It basically is built on the blockchain, and when you link it together with our existing tech backbone, basically a contractor can say, I've worked 8 hours today, and my approving officer has confirmed that I've worked those hours, and then the instructions are given for them to be paid. And this is earned wage access, which in many markets, whether in India or Indonesia, they would actually have to pay an administrative fee or even interest for the access to their wages. But we're very happy to announce that with Octomate, we are able to offer it without any further charges to our contractors. So it's a big draw. As in when we announced it, I think we had really, really good feedback. And we fully intend to make this solution available to other payroll service providers and companies as well, because Octomate has its own clients. So that's just to give you some flavor as to both the people as well as the technology aspect of what we've been doing. Yeah.
Thank you, Albert, Adeline, and Jennifer for the sharing. Up next, we now come to the second segment. May I invite Mr. Paul Chew, Head of Research, Phillip Capitals, and Miss Rhiannon Ewart, Managing Director from Storm Corporate Research, to share their perspective on HRnetGroup. Over to you guys.
Hi, this is Rhiannon from Storm Research. Just a very quick intro on myself. I've been analysing companies across Asia for just over 25 years now, and set up Storm Research in 2009 to help companies with their research for investors. I'd like to cover today just very briefly about HRnetGroup's unique differences and features versus other companies that we see in the recruitment world. I think we saw this in Jennifer's presentation, but I think it's a really key slide, as the ability to produce consistent growth relates to HRNet's really unique characteristics that differentiate it from the other recruitment operators. As we've seen, it can generate these points because of its differentiation. And those unique points are threefold: differentiation, co-ownership, and the balance sheet. Jennifer was talking about differentiation, so I'll just briefly go over that area. They firstly have diversification in their sectoral exposure. This includes technology, financial services, and healthcare, life science. So in all economies, they have a broad revenue base derived from a diverse client roster. And as Jennifer mentioned, it allows them to cherry pick and focus on the areas of growth at that time. And that goes the same with its geographic exposure. It's not just limited to Japan or certain areas of Asia. It has geographic exposure across 15 Asian cities and 40 offices across Asia, which is really an unrivaled geographic spread, which again gives it that diversity to weather storms in certain areas and benefit from growth in other areas as well. And finally, on its diversification, I'd just like to point out its two business models, which Jennifer was talking about in detail. Flexible staffing business and professional recruitment business. The flexible staffing business is a very stable business, while the professional recruitment business really gives it some extra gearing towards economic growth. And the fact that it has both of these businesses really allows them to generate consistent revenue even through economic downturns. The second point that I think that is truly key, which Adeline was talking about as well, is the co-ownership model. And this is really truly unique to the staffing industry and harbours a relentless focus on generating profit over revenue or market share. They have 37 business leader co-owners who are motivated by variable bonus schemes, and compensation is tied closely to profit generation. And I think this really gives HRnetGroup a real business agility that we don't see at other companies and allows them to be really flexible when there is the need to change, whether it when the focus geographically, locationally, or within their two business units. Finally, again, another point that has been touched on, but I think is one of the key points in terms of their differentiation, and that is the balance sheet. It's in a very enviable position, obviously, of having net cash in a rising interest rate environment. But it's not just that reserve of cash, which, for example, many Japanese companies just keep as the ongoing war chest. It's the proactive use of that strong balance sheet that really distinguishes HRnetGroup. For example, recently, as Jennifer mentioned, they have the ability, or they had the ability recently, to be able to really scale up at short notice with that cash flow on hand. When demand is strong, they can therefore react very quickly to change as a result of that balance sheet. I think one area that most investors are very grateful for is the ongoing dividend and share buybacks that we know is very stable due to that balance sheet strength. And it also places them in a very enviable position for potential M&A opportunities, as we've recently seen with the acquisition of Optimate. So I think this chart we can see on the slide is testament to these three key unique factors that they have over their competitors. And in summary, I think they're just uniquely well positioned to capitalize in the current tight labour market and over the long term in different economic headwinds. So thank you very much.
Yeah, thanks. Hi, everyone. So thanks for the invitation. So this is Paul here from Philips Securities Research, Head of Research. So I've been asked to talk about the recession. So for us, we think a slowdown is happening. It's almost inevitable, but not every sector will face it. I think what you see is that the local economy, the domestic economy is very exceptionally strong. But regardless, we as an analyst, we've really kind of factored that into our model. So for revenue growth, we are looking at mid-single digits. So we already factored that in. But more importantly, there's three reasons why we are still comfortable with HRNet. Not to mention, we have 300 million. So you do the back envelope, 2 percentage points increase that in interest rates, that gives them 6 million. So you get like a 10 percentage point tailwind for earnings. But anyway, we're not going to count that. So just three reasons. Firstly is despite the weak economic conditions, labor markets are still very tight. So some of the key countries that they operate in, like Singapore and Taiwan, if you use, like, broadly speaking, unemployment rates, just very broadly as a proxy, it is either back at pre-pandemic or even better than pre-pandemic, the unemployment rates. If you look at China and Hong Kong, it is still higher than unemployment than pre-pandemic, but it is trending down. Second thing is, of course, during the last recession, which is technically 2020, I think the earnings was dipped only about 10%. And the third reason, which is more critical for us, is the ability to maneuver. So, you might have a recession, but of course, if you're only servicing the hospitality industry, if in 2020, obviously your earnings won't only drop to 10%. So key to us is the ability to maneuver into the more, I guess the sectors that are recruiting more aggressively. Like in China, they've managed to maneuver into maybe into the tech sector. And some of the ingredients for that would be, of course, like was mentioned by Adeline, the co-owners, which, if you don't understand, is more, you can think of it like lawyers having some partners in a law firm that can help. So that gives you the volume, and then behind the scenes, because of their scale, they have specialists, not only sector specialists in various segments that I think which Jennifer showed, and also functional specialists, IT, accounting. So that broad bench also helps them service and maneuver into whichever sectors are performing well. Yeah, okay, I don't think I want to take that much more time. I hope, and I guess just one last point is that, why do you want a recruitment firm in your portfolio? I mean, that's the basic question one should ask. One of the things is also because of the financial metrics. If you look at the return on capital employed for this company, is almost 50%. What we mean is that the capital they employed, which is hardly anything, but it's mainly on the trade debtors part. If you want to do some computation, they virtually make like 50% on any capital that they deploy. I mean, just a rough sense. Yeah. But I think with that, I'll just wrap up on my side. I think hand it back over to HRNet. Thanks.
Thank you, Paul and Rainer. We have now come to the last part of the section, which is the Q&A session. Once again, may I invite back Ms. Adeline Sim, Executive Director and Chief Corporate Officer, Ms. Jennifer Kang, Group CFO, as well as Mr. Albert Ellis, Non-Executive Independent Director, as well as the moderator for tonight's session will be Mr. Benjamin Goh, Head of Research and Investor Education from SIAS. Over to you guys. Okay,
thank you very much, Eileen. So very grateful for the opportunity to speak to yourself, Adeline, and I really like the word they use just now, instigated. So at SIAS, we are kind of in love with small caps that tend to punch above their weight. And since the last time we spoke, you were on our Corporate Connect program. The sentiment that I kind of alluded to previously has been kind of articulated by both the independent research analysts here. So it's about the agency or the co-owner kind of structure that you have, which is not common, as well as the superior financial ratios that the company has been being able to generate over the years. So that has been breath of fresh air, right? I mean, most of the companies in Singapore as well as the US is the same so this is different, which is interesting. Okay, there are a couple of, or rather, I've counted 2 elephants in the room, with regard to the pre-submitted questions, and maybe we can get those out of the way first. So the first one is obviously about a recession, right? So there's talk about recession, how severe it is, how mild it will be. Nobody kind of knows when the interest rate hikes will end, so on and so forth. So we've got a bunch of questions really regarding about if there is going to be a recession, how is that going to affect the company's businesses, as well as expansion plans, as well as the day-to-day stuff.
You're muted, Jennifer.
Hello.
Hey.
I'll take that one.
Okay.
First of all, professional recruitment volume might be impacted in a recession scenario. The volume might be impacted, but the wage inflation impact could possibly offset the reduction because our fees are a percentage of salary packages of successful placements. In the event of a recession, sectors such as healthcare, fast-moving consumer goods, FMCG, the government sector, the semiconductor sector, these are very defensible sectors. We believe that they will continue to have growth and continue to have hiring needs for professional recruitment. Typically, we would have flexible staffing trending up in the face of a downturn. And those companies facing uncertainties, typically revert to stepping up on flexible staffing for junior to mid-level hires and convert to permanent hires when there's more market visibility that turns positive.
Okay, so it sounds like the mix of the business as well as the hires may change if, let's say, there's a recession, but I suppose that's not gonna materially impact your top or bottom line.
That's right. The dynamics will change, they will shift, but we've got the natural hedges all in place.
Okay. All right, so that means in plain language, if I'm retrenched then and I need to get a gig with Grab as a driver, I can come and see you guys, right?
Amongst many other positions.
Okay, good. Yeah, I'm sure you can find a good fit for my skill sets or lack thereof. All right, okay, so that's great. Now the other big elephant in the room is obviously China. So China has just completed their 20th National Congress of the Chinese Communist Party, and that's really quite a mouthful. And it looks like by reading the tea leaves, the pundits have come to the conclusion that COVID-0 is here to stay. How is that gonna affect what's happening with your business in China, considering they don't really have that great a vaccination rate, and lockdowns are common, and it's kind of start and go, and there are slowdowns in the technology sector. Youth unemployment is clocking in about 20%, so on and so forth. So it sounds like there's a lot of headwinds. How is that impacting HRnetGroup?
So maybe I can just give some color. Once again, I think it's really where the talent will flow and how we can play a part in it. So, for example, the technology companies in the previous years, with the fresh grads of each cohort, they sucked up thousands of the interns, right? And everybody else couldn't have access. So this time round, we had very excited clients who are like, oh, finally we get to access, the fresh grads who are working in AI and other areas that they're interested in, because they're not being just sucked up hook, line, and sinker. So my point of giving the example really is that, especially in China, which is a huge market and where we are so small, it's really about how we organize ourselves to quickly pivot and be able to play that role, very quickly, and to find talent and put them in the right place. So, the investments in EV, for example, continue. There are definitely those pockets, like Jennifer mentioned, there are those pockets that are still getting investor dollars, they are still defensible, but of course, there are also the very high profile bust-ups. So we have to be very careful to withdraw from clients where there's very high credit risk, and then actively engage and move into those spaces which are still growing. Yeah.
Sure. And it does sound
Benjamin,
like...
Benjamin, if I can just add very brief thoughts. I know that you haven't asked me specifically, but back to the recession and your second question, they're somewhat linked. Actually, recessions create great opportunities because, for example, hiring talent is a big challenge for a successful business. So recession definitely allows you to access talent that you would never have been able to access before. The other point is, if you've got a strong balance sheet, you can muscle your way into markets you previously didn't have. So competitors are weak. Debt is the perennial curse for most companies, particularly in the West, where lots of corporates are debt laden. So if you have cash and you've got strong culture and successful track record, you do two things. You can use your balance sheet to muscle in quickly in areas where customers have got a failing confidence with their supply chain, and secondly, you can hire talent. Just on the China point, actually, the main fears and concerns in the Western Hemisphere is all about supply chain. And of course, that's exemplified by the Chinese lockdowns. But in our business model, we've proved over the last 2 years, which we didn't know 2 or 3 years ago, that through use of technology and clever use of technology and client and candidate acceptance and use of tools, we are much less affected by lockdowns. So some points there that are linking the two questions.
Okay, Albert, and I can see why you are the wise man of the group here. That's certainly a lot of pearls of wisdom. As investors, we tend to focus a lot on growth and revenue and so on and so forth. But you're absolutely right. There is an opportunity here, and given the business model as well as the initiatives that you've put in, that's probably going to be the right approach going forward in times of recession, as well as what's happening in China, right? Obviously, this conversation will go differently if you guys were in the property market, so different thing. All right, okay, so those two big elephants out of the way, let's talk about the business itself. So we've got a couple of questions. One is, okay, related to China again. Would you be comfortable adding some color to your second half financial results? And obviously the fourth quarter is not out yet. Given what's happening in China as well as globally speaking. It's if you're not comfortable with that, that's entirely fine as well, since I'm only asking you to provide information that you
It's still a very dynamic situation in China. So, but the tenacity or the adaptability of human beings is amazing. Just a few months ago, people were struggling with basic necessities during the lockdown in Shanghai. But today it has become a usual way of life. That occasionally you've got a colleague in that part of the city that faces a lockdown in the building that she stays in, and then everybody else just goes back to the office as usual. So I think people need time to get used to things, and it's just going to be a way of life, just as we had been in the last 2 years in Singapore and elsewhere.
Okay. On a longer term basis, there is a question about the industry's growth rate for the next 5 years. Would you be able to provide some insight into that?
Yes, according to a research and markets report, the global employment services market is forecast to grow at a CAGR of 11.9%, worth some US dollars 2.5 trillion. That's a lot of money.
Yeah, I could use some of those actually, but okay. So it sounds like the growth rate is quite respectable, and okay, so that's good. The other question is regarding some of the social media platforms, for example, LinkedIn. Yeah, so LinkedIn is like the big boys version of Facebook. Basically, use it for professional reasons rather than to chat up random people. How does that affect your business model as well as your company?
For us, it's just another platform that we use to reach out to candidates and to clients. So definitely we use LinkedIn, but we also use TikTok, we use Insta Live, we use Facebook, we use WeChat. So any channel basically that we can reach out to people, engage with them, put them in the right job, you'll find us on it.
Okay, so they're not really what you would say competitors. They're more like modes of communication to increase your engagement and outreach.
Yeah, not at all. And they don't consider themselves as competitors either. So actually LinkedIn organizes, gatherings for all the recruitment companies who are their clients.
Oh, okay.
Yeah, so no, they're not competitors at all.
And I'm curious, you mentioned TikTok. How does well, I'm old dinosaur, yeah. So but how do you, TikTok is what, 15 seconds of video? How do you actually get your message across? And
Well,
I'm
more like
just curious.
60 seconds or
60,
now
okay.
180, but basically whether on Douyin or TikTok, we kind of give very, very short, succinct videos that job seekers could be interested in, or even, what jobs are currently available. So you have
Okay.
just a short video with, the current available jobs that we're working on and how much it pays. But because that generation of job seekers are used to consuming content in video format, therefore, it just resounds to them a lot better than with the rest of us. Yeah.
Right. The dinosaurs. Okay, I get you. And for TikTok, what's your reach? Is it the local Singapore market, or is it US, or is it China, or?
So it's always in market. So in Jakarta we have it in Bahasa, and then in China it'll be Douyin. So it'll be within Shanghai, and yeah, it's very localized basically. Yeah.
Okay. So another thing I learned about HRnetGroup today. Right. Very flexible, speedy, time to market, so on and so forth. Right. Okay, good. Okay, the next question is, I think, something that we've spoken about previously, is about the gig economy. So how will the rise of the gig economy affect the business model of HRnetGroup?
So basically, yes, most of them have been our clients, whether it's Uber or any of the current gig economy platforms have been our clients, because the reality is that in order for any company to grow quickly after they've taken in that influx of capital, then the next thing you need to do is to spend it on talent, and the best place to do so would be with us, right? You need to spend on talent because otherwise there's no output. So that's why you have to spend on talent, right? And it's the fastest to come through us because it's just one phone call. Oh, I want 300 people on the line, right? And we will supply them in some cases overnight. And then whenever there's a lockdown or some big movement, it's again another phone call. Okay, tomorrow onwards, I don't want them. And then we then manage this entire workforce. So it's actually a workforce talent management solution that they seek when they come to us. And for certain clients, they will actually go so far as to say, I want guaranteed seats. So come what may, I want 100 people there tomorrow morning. We have to ensure that 100 people turn up. Yeah, so I think that level of speed and service which we offer is unrivaled, actually. Yeah.
Yeah, I can't imagine how you accomplish that, actually. Okay. So, yeah. All right. Okay. There is a question here about higher interest rates. So, your company generates quite a fair bit of cash, and the higher revenues, right? So, would that higher level of revenue as well as cash earn higher interest rates on a full year basis?
Yes, definitely higher than last year.
Okay, is that a material impact to your bottom line, or you use it as working capital, or?
It might become more and more material if we don't spend it, because the interest rate is rising by the day.
Okay, no, that makes sense. And I guess that was kind of a lead into one of the quite popular questions that we have in the pre-submitted questions regarding your payout ratio and your dividend. Right, so you've got retained earnings, you've got cash flow coming in, you've got high interest earned on your reserves and your retained earnings. How is that? Is that going to lead to any kind of change in your payout ratio? Can investors, again, just put it out there, being the devil's advocate, expect higher dividends in the quarters going forward?
We intend to maintain the same payout ratio of 50% of underlying profits. And underlying profits refer to the net profit after tax, stripping off any exceptionals, such as unrealized revaluation gains or losses. So that's the practice for dividends. On the subject of how we are dealing with dividends, we actually stepped up our dividends from 2.5 cents in respect of 2020 profits to 4 cents in respect of 2021 profits. So you've already seen that step up in the numbers. This year alone, 2022, we've already paid up 6.1 cents in dividends. And we have also started to declare and pay out interim dividend after the first half 2022 results. I think that's been quite a lot of step up towards shareholder returns, especially in 2022. And of course, we would want to look at more progressive dividend payouts going forward as we make more money for our shareholders.
Okay, that's couple of very interesting keywords. Make more money for shareholders, always an attention grabber. And I hate to ask, but some other sectors materially impacted because of high interest rates, because of the debt load that they have. Is that a material factor for HRnetGroup? Is the high interest rates gonna be an issue because of the debt load that you have?
No, we are very focused on credit review when it comes to customers. And on the other hand, we are also on an active lookout. In fact, a lot of companies have been coming to us because of debt problems. And I'm referring to recruitment related companies offering themselves out for sale. So when I say that companies are out for sale, it's real.
Okay. But I guess, let me paraphrase my question. The debt load of HRNet itself is not significantly high, correct?
There's no debt.
Yeah, there's no debt, right? So this will not be an issue at all, right? High interest rate. So it's basically a plus that
absolutely. There will only be interest income.
Right. Okay. Cool. Because earlier today I had a different conversation with a REIT. Yeah, so that was a different thing. All right, cool. Now, so apart from dividend payouts, another way to generate returns for shareholders, obviously higher stock prices, but also in conjunction with that will be the share buyback, right? So there is a question here about does HRNet have any plans to increase its share buyback of the company shares, given that there is a healthy level of cash in the balance sheet?
Well, I've been signing off. Sorry.
Yes, go ahead.
I've been signing off the announcements every evening. So we have been happily buying back. Sorry, Jennifer, you're going to say something?
Yeah, similar.
Okay. All right. So, just trying to kind of nail it down a little bit. So the question was any increase. So you have a certain share buyback plan currently, right? Are there any plans to change it in the sense that you want to accelerate that?
That's $30 million, 30 million Singapore dollars. That's equivalent to some at today's price, it's some 40 million shares to buy back.
Yeah.
For as long as the cardinal rule of 105% price cap is observed, I think we can exercise quite a fair bit of buybacks.
No, fair enough. And obviously you want to be flexible in how you want to execute your share buybacks. You don't want to buy it at the height of the market. That is not going to create value for shareholders in the long run.
Well, whether it's at the height of the market or at the throw of the market, the point is we will do share buybacks for as long as we see that the share price is undervalued and for as long as we're not in the blackout period.
Right. Okay. All right. That's a healthy chunk of change, about 4 times the total first price 2 weeks ago. Yeah.
Benjamin, I think it's difficult for Jennifer to find anything else that gives 7.6% returns that's like guaranteed and practically risk-free. So that's the problem.
No, I totally understand. I I totally understand.
Are you convinced to put your money in HRnetGroup?
No, I'm going through the questions. I've seen the business model and the numbers, so I've got my own opinions. And I did mention that I do am in love with your business model, so that already it's I guess a vote of confidence. All right, next. Okay, regarding the liquidity of the stock, how does management intend to improve the liquidity of stock? I guess we're talking about trading volumes and so on and so forth.
So I think that there are multiple things that we're doing at the same time, whether by way of using the shares as consideration in M&A. So that was the case for Ultimate as well. So Zoe actually took her consideration in the form of shares. And then for employees, there's also the option of being paid or having the compensation paid by way of shares, which I believe, yes, we do have some people who have already elected to do so. And we'll continue doing so. Yeah, so we understand this issue with the concern as to liquidity, but it's a very careful balance between, doing the buybacks, which we really believe in because we think that it's way undervalued and it's a great investment for the company itself. To invest in itself at 7.6% returns is just fabulous, right? So whilst we will find more ways to kind of put more shares out in the market. But at the same time, we will continue with the buyback. So that's where we are.
And certainly, investors need to be cognizant of the I guess the fact that there are different ways to make money off stock investing. You've got share price appreciation, there's dividend yield, so on and so forth. So many ways to skin a cat. So for the people out there, our friends on the line, think of it in terms of total return. Not just one or the other, but a combination of both. And that's something that we kind of preach as well at SIAS. All right. Okay, so there is a question here about whether or not HRnetGroup has any intention to de-lease, I guess, to take private. I suppose that's the time when all of you will cash out and then buy our yacht in some private Caribbean island somewhere.
The answer is no.
Yeah, I like the way she says it, very brutal. Okay, so no, right?
No.
Okay.
Actually, I think people actually take comfort in the fact that we have been steadfast about not delisting. Because if we wanted to sail off into the sunset, the people working in the company own 80% of it, right? It would have been the easiest thing to just delist and sail off into the sunset. And we've been offered multiple times by the PE funds as well. Oh, do you want 250 million for a 25% stake? As in, after a while, it becomes a bit boring when people keep throwing money at you. But I think at the end of the day, as a team, as all the co-owners and everyone as in the company actually firmly believes that we really enjoy what we do. And we can make a lot more money growing this company with its shareholders. So why sell out now? As in, where would be a better place to be? There's no better place to be. There's no better place to make money. So let's just dig in and have fun.
Yeah, I like that. And I love what you said just now about it gets boring when people throw money at you. I would love to have that problem, yeah. I guess the motivation behind this question is probably related to the previous one about the liquidity of the stock. Because in general, if the stock price doesn't move, and sometimes the majority owners might want to kind of take it private and restructure, so on and so forth. So I guess that's probably why.
No, that's why I would say never, right? If tomorrow the share price is 20 cents for whatever reason, there's a war or something bad happens, then sure, of course we'll take it private. I mean, why not? It's a windfall. Yeah, but and having a listed vehicle, I think has definitely proven itself to be beneficial for us as a company, and we're happy to continue as it is.
Sure.
Benjamin.
Sorry, Albert, yes.
Yes, just to add a couple of thoughts. Adeline and Jennifer may have articulated the answers to that question, which of course gets asked all the time here in London of all companies. Why aren't you selling? Why aren't you taking private? Why aren't you doing this? Why aren't you doing that? But the question is very interesting because what it ignores is that one of the best places to be for your customers is a listed entity. Successful, of course. If you're not successful, it becomes the inverse. It becomes the opposite. But if you're successful, it's the best free advertising for your customers and your candidates that you can possibly get. So there's a hidden benefit in being successful and being public. For internal staff, it's very helpful for the transparency. The faith and confidence is very high if they can independently hear people like yourself and the organizations that are supporting this event. They can see opinions that are external to the company. They don't have to rely on the company internal communications. So there's lots and lots of good reasons, particularly if you're successful. If you're not successful, all the positive becomes the negative. So that's obviously the spike in the tail. But being public, I've been in recruiting for 30 years now. All of three have been public. I was involved with taking Harvey Nash private for the private equity business, and you face different challenges. Of course, the opportunities are different, but essentially the biggest challenge you face is you literally are switching off the lights, and now everything you do and you say has to be, you have to turn up the volume yourself because you have no platform.
Yeah. And Albert, you are the independent director of HRnetGroup, right? And I'm gonna put you on the spot here. So, from the perspective of an independent director based out of the UK, an Englishman, right? If you have run, HR organizations previously, just between you and me, what's so great about HRnetGroup? I mean, like,
Wow, I mean, if I can, you probably don't live in London, I presume, so you'll not be exposed to the various troubles and ups and downs of particularly recruitment companies, and they are seen as either as boom and bust. In the good days, when the economy is strong, this is in the US in particular as well. They roar ahead and they power ahead because demand is virtually unlimited. We need people. Please get us people. We'll pay whatever you ask. But then the reckoning comes with the downturns and the recessions, and every decade the new generations make the same old mistakes. Debt is one of the major problems, but also growing too fast or having a bad culture. A culture that's not the right culture. All of these things mean that recruitment businesses are some of the easiest businesses to run if they run well, but they also, if they not run well, they make some of the worst mistakes. So when I look, and I've been involved in businesses all across the world in recruitment, and I look at the characteristics of HRNet, and I've been observing it for 5-6 years. I'm acquainted with the management, senior management, and the board. I'm amazed at the commitment to success. So when my own board at Staffline says, "What is it that HRNet have that makes them so special?" I've tried to crystallize the thought in a very simple word, which is the dedication to success. It's virtually. And I've never seen it anywhere in the way that it's manifest in HRNet, this commitment to success. That means that non-performance or underperformance is self-punishing. People will deselect themselves if they're underperforming, and they are motivated by performance, and they will only spend the money that they see as their own money, which is unlike most companies in the world, which spends accounts, private jets, first-class travel, and credit cards, corporate credit cards. This is the complete antithesis of this culture. And that's what's so extraordinary. So I crystallize it in the commitment and total dedication to success. Maybe a little bit like Elon Musk, Asian version.
Yeah, but without a weed, I suppose. I'm just kidding. And it's we've run out of time and questions, but I also say that your comments, Albert, basically harks back to an era where people really cared about quality of work, pride in their work. To be quite honest, we at SIAS, we do have many investor or other presentations by companies, and generally it all boils down to financial ratios. I've not heard the word dedication for a long time. Seriously. No, I'm not BSing you, but he hardly comes out. right? It's all about debt load and fixed or floating interest rates, you know, so on and so forth. Yeah, so that's a breath of fresh air for me personally as well. All right. So thank you very much, Albert, Adeline, as well as Jennifer. Very illuminating as usual. And again, I have learned something new about your company. And again, I've remembered that myself. I'm supposed to send you my CV so that you can help me dress it up, right?
We need you at SIAS, remember?
Oh, real? Yeah. You're not gonna help me find a job as a Grab driver. I get that. All right. All right. So thank you very much. I'm gonna hand the time over to Eileen.
Sure. What a robust discussion earlier on. I think before we close, are there any last points for our audience tonight? Annalise?
So I just want to thank everybody for joining us this evening, and SIAS in particular for, I think it's a really interesting format, right? Where you have the experts, Rhiannon and Paul coming in, and then you have Albert dialing in as well to give you a totally different perspective, because most shareholders will only meet Jennifer and myself. So it was really fun to get, such a strong panel, such strong minds. And I think it's really a great reflection of who we are as a company to tap on internal and external strengths. Whoever is best for the job, please come forward, and that's us, right? And Benjamin, I appreciated you pointing out that, yeah, I think we're different because we're really about people. So it's something which it's perpetually on our minds, right? How do you engage better? How do you bring out the best? How do you make people more productive? That's what we obsess over. Yeah.
Thank you for the kind words. How about Jennifer? Any last points?
Yes, I just want to take on one question that one of our participants asked: how can we apply the investment concepts and strategies? And I just want to leave you with acronyms. Singaporeans, we love acronyms. We have the MRT, the ECP, and what have you. Today, I would like you to remember SSDD for HRnetGroup. And S stands for stable performance, strong balance sheet, sustainable business model. And D is steady dividends and defensible diversities that we have.
You need to throw in dedication as well. I really love that one,
Oh, yes. One more D.
To jaded research analysts like myself, Storm Research, as well as Phillip Capital, that is a breath of fresh air. I don't know about you guys, but
we've been taking it for granted.
Okay.
Thank you.
Okay.
Well,
All right.
interesting. Okay, I believe Albert would be giving us a short closing remark. Over to you, Albert.
Thank you. Yeah, I mean, this has been an absolute pleasure for me too. So I'll echo Adeline's lovely words. And, this is the first time I've really seen some of the interactions in the local market in Singapore about HRnet. It's been very impressive. And, thank you to everybody involved, because it's been enriching as an experience. One of the things that you mentioned, Benjamin, was the ratios. This is something that is really impressive. You look at Apple, you look at the pharmaceuticals, their ratios, their ability to turn a dollar into net profit is very good, and they're very high ratios. Microsoft, of course, most services businesses have single-digit conversions, or maybe if they're very fortunate, 10%. So when you look at the conversion ratios at HRnet, bearing in mind it's not selling an Apple iPhone or product or a miracle drug, those conversion ratios are unequaled anywhere in the world, and I've studied recruitment companies everywhere. So it's really all about productivity. So that's one thing we didn't talk about, but I'll leave you with that message. It's a strong focus on productivity. Every management tool, every review, every interaction is all about productivity. And we know that here, particularly in the West, in England, productivity is being mentioned by, the sorts of Goldman Sachs and other commentators about the big challenge facing mature economies. So if I've got the key to unlocking productivity in a company, you've got something very special. And I'll finish with that. Thank you.
Well, thank you very much. I think for the last 1.5 hours for your attention, as well as thank you panelists for the insightful sharing. We have now come to the end of the session and appreciate everyone for joining us this evening. Well, if you have any further questions, please feel free to contact Adeline or Jennifer of HRnetGroup. We look forward to have another upcoming investor education program. Do visit our SIAS website for more information. Thank you and have a good evening. Thanks, everyone.
Thanks,
Bye.
bye.
Thank you.